Hi everyone, Nick here, welcome back. The US stock market went down 19.5% last year, but one of people's favorite dividend ETFs, SCHD, only went down 3.23%. Even better, if you compare the performance of SCHD against the total stock market, SCHD has outperformed by an average of nearly 1% annually over the past 10 years, with lower volatility. Many people are attracted to these funds, and I've had several people asking me about them. Well, I think SCHD is a great fund. I would not add it to my portfolio. In this video, we'll discuss why people like investing in dividend funds like SCHD. Then I'll share reasons why I discourage my friends and family from investing in dividend funds. These are reasons I don't see many people talking about, and I want to share them with you. That's my goal on this channel. I want to help you make more informed decisions and be one of the smartest people when it comes to investing and planning for retirement. If you get value, make sure to press the like button and subscribe to support free financial education. So why do some people prefer investing in dividend funds? Well, many of them like to get a regular cash flow. There's something nice about seeing dividends deposited into your account. Retirees generally need money to spend, and dividends can help provide that cash flow. Additionally, some people just don't like selling shares for whatever reason, and they just prefer to get dividends. Another reason is SCHD has recently outperformed with growing dividends and outperforming the total stock market or S&P 500. A minority of investors might be seeking a value tilt through dividend ETFs like SCHD. These can provide indirect exposure to factors. Factor investing is based on academic research that suggests you might be able to get a higher return by exposing yourself to different factor risks. Now, I made another video specifically on this, which I'll link up here and below. There's another type of person, like myself. I work for a big tech company. I receive a large part of my compensation in the form of restricted stock units, or RSUs, where I get shares of the company and then they vest over 4-year periods. Now, this gives me a massive overexposure to big tech, which happens to be a very large part of the total US stock market. Now, if I wanted to diversify away from some of that overexposure to growth or big tech companies, tilting towards value could be a good option. Some people might prefer to get a value tilt for this reason. So let's take a quick look at some more details of SCHD. Whenever you invest in something, you should understand the principal risks and investment strategies of that investment. You can do this by reading the fund's prospectus. In this case, we could download SCHD's prospectus from Schwab's website. So if you do that, you'll learn that this fund tracks the US Dow Jones Dividend 100 Index. This is the fact sheet from S&P Global, who manages this index. They apply some strict criteria to determine which stocks to include and remove from the index. We can read that here. It's quite simple. So first, there's 3 criteria a stock must pass: a minimum of 10 consecutive years of dividend payments, a minimum float adjusted market capitalization of $500 million, and a minimum 3-month average daily trading volume of $2 million. So then they take the dividend payments and they sort all these stocks meeting this criteria in descending dividend payments. And then the top 50% are eligible for inclusion into the index. Next, they weight those stocks by these 4 criteria: free cash flow to total debt, return on equity, the dividend yield, and the 5-year dividend growth rate defined by this formula. And these are equally weighted. Based on these ratings, they decide who to remove and add with a methodology to keep only 100 in the index. So there's criteria to remove companies that get a lower rating over time, and then to replace them with new companies to keep it at the 100 stock limit. Now there's a couple other nuances we're not going to go into. That's generally how this works. When a company earns money, it has three options for what to do with those earnings. They could reinvest it into the company, potentially delivering even better returns in the future. They could pay dividends, returning capital to their shareholders. Or they could engage in share buybacks, which is just another form of returning capital. But instead of paying it out as a dividend, they buy shares, reducing the number of shares and driving up the value of existing shares. It's just another form of returning capital. Why prioritize companies that pay dividends over those that reinvest in the company or buy back shares? Only 40% of US stocks pay dividends. So by focusing on dividends, it excludes most companies. It means your portfolio will be less diversified, so there should be a good reason for it. This methodology, dividend investing, is not supported by any research that suggests it's a better way to invest. Most research suggests that dividends are irrelevant to expected returns and can actually expose you to extra uncompensated risks like overexposure to certain sectors. Do people investing in SCHD or dividend companies actually have a good reason for it? I've spent a lot of time reading arguments for and against dividends, and I think most investors in these funds prefer to get dividend payments and get some psychological benefit of receiving regular dividends. Maybe some feel it's better than selling shares. If you invest $10,000 in two companies, and your stake in the company results in earnings of $1,000 of income, does it matter if you receive a direct $1,000 payment or if your shares just increase $1,000 in value? If you want the $1,000, you could just sell $1,000 of shares and still have $10,000 invested in the company. It may be less shares, but the number of shares owned doesn't matter. It's the value of those shares that matters. The main reasons I generally don't recommend using dividend-focused funds are taxation and flexibility, which are something I think many dividend investors overlook. I've seen several people start out as dividend investors, but later change their mind due to these reasons. Outside retirement accounts, dividends are taxable immediately, whereas growth is only taxed when sold. This subtle difference can make a major impact. Let's briefly look at the dividend tax brackets. There are two main types of dividends, qualified and non-qualified dividends. Now, non-qualified dividends are taxed like ordinary income in the regular tax brackets. This tax bracket is for qualified dividends. And funds like SCHD or the Total Stock Market Index or S&P 500 are mostly qualified dividends. They're taxed at lower rates. This is similar to long-term capital gains tax brackets. So a married couple filing jointly can earn almost $90,000 and pay 0% taxes on the dividends. This isn't just dividends. This is including all income. So if you earn $80,000 from your job, that factors into this. You could then earn $92.50 from dividends and pay no taxes on those dividends. And as you can see, the 15% tax bracket's quite generous, up to over $500,000, and then at some point you get into the 20% dividend tax bracket. Now, in addition to this, there's something called net investment income tax for a married couple filing jointly. If your income is over $250,000, you have to pay 3.8% tax on investment income. This brings us to the final major point, and that is flexibility. When you're a dividend investor, dividends are basically similar to a forced sale of your stock every year, to the tune of around 3.5% right now. If you have $1 million portfolio in SCHD, your dividends would be about $35,000 each year. Whereas a $1 million portfolio in VTI would only have dividends around $16,000 each year. This is a major difference in your flexibility to control when you pay these taxes and when you recognize this income. This flexibility when it comes to tax planning is extremely advantageous. Instead of being forced to take possibly over $20,000 a year in extra income you might not want or even need, you could defer it inside a growth portfolio. One of the major benefits of deferring taxes is you may never have to pay them. For instance, if you're younger or growing in your career and paying higher tax rates now on your dividends, well, if it was instead being deferred in growth, your tax rate might be lower in retirement. Or you might not need all of that money in retirement and you're going to leave it to your heirs. And then all those baked in gains, you never have to realize. And the cost basis steps up when your children or your heirs inherit those shares. I've seen many people start out thinking, I'm in a low tax bracket, the dividend tax rate is favorable, why not pay the taxes? But then they build up this big dividend portfolio, they grow in their career, they earn more income, and all of a sudden they're in higher tax brackets, they're paying net investment income tax, and now they're paying about a quarter of their dividends and taxes, when they could be taking advantage of different tax planning opportunities that are no longer on the table. Then even for retirees, there's tax planning opportunities available, even if they're in the 0% tax bracket. For instance, I recently made a video on how you can earn $109,750 purely from investment income in a year and pay no taxes. There's also strategies where you could be converting a lot of your traditional 401k or IRA to a Roth and paying under 10% taxes on that. And if you're getting massive dividends kicked off from your portfolio in retirement, you're going to have much less opportunity to pull these different levers and engage in this tax planning. Make sure to check out my video on this retirement income tax planning, which I'll link up here and below. So these are some of the reasons I generally don't recommend focusing on dividends to most people. The taxes and the limited flexibility as you scale your portfolio. I do want to caution against buying funds like SCHD just because they did well recently. Our investing horizons are probably around 30, 40, or maybe 70 years for younger people. We really need to focus on the strategy and the reason why we're following that investment. And it shouldn't just be because it did well recently. Now, some people, I think it can be rational for them to invest in dividend funds and add them to their portfolios. For instance, a lot of people get a major psychological benefit from the dividend payments. And we need to have investment strategies that work for us. So if you get value from dividends, who are we to tell you you are wrong? If you think it's best for you, do it. It's much better to have a strategy you can stick with than the best hypothetical portfolio from some research. Your conviction will be much higher and you'll be much more likely to stick through it through downturns and not make behavioral errors in your investing, which are often the most costly kind of errors. Aside from the psychological benefit of the dividend payments, another rational reason could be the factor value tilt. This is probably not the best way to get a factor value tilt, but it is a reasonable, simple way to do it if you want to. Could also be good for people working in big tech that have extra exposure to growth to get away from some of that extra exposure. Now again, I don't think this is the best way to get this type of factor exposure. I did make another video on factor investing if you want to learn more about it, which I'll link up here and below. So what do you think about investing in dividend funds? Let me know in the comments below. I'm interested to hear your thoughts. Thanks for watching, everyone. If you got value from the video, make sure to like it and subscribe to support free financial education. Later.